Ikaw na maka-conflict. Ayok mo makuha ko 1 hour and naka-zoom na. Okay, good afternoon. Let's continue with chapter 16. Last time, we were able to take problem 16-1 involving preparation of adjusting entries and as well as the worksheet giving us the corrected net income for the period for 2 years after the corresponding adjustments and corrections were made. So let's now go to problem 16-5. The requirement is to determine the corrected income before tax. So the corrected income before tax is computed. Let's start from the income before tax per book is 5 million, and then we add prepaid insurance. Actually, this was not recognized. So we have to recognize by adding it to net income because the failure of the company to recognize prepaid insurance at the end of the year, meaning all the payments for insurance were charged to expense. That resulted to a lower amount of net income. So we have to add back. Then for accrued wages, we have to deduct. Again, we deduct because not all the wages were included. The fact that the company was not able to recognize accrued wages, meaning the debit to wages was smaller. That's why we have to deduct back from net income. The rent revenue collected in advance actually is a pre-collection and it is still considered as unearned income. It's not yet income. But the company failed to recognize pre-collection of rent. So meaning when collection was made, the amount collected was debited to cash and credited to income, when actually it's still a pre-collection. So we have to deduct back from the amount of income reported. Then the interest receivable of 100,000. In other words, you still need to recognize additional interest income for the period. But the fact that the receivable portion was not recognized, meaning net income was understated. So the amount of corrected income before tax is 4,750,000. That's letter A. We go to 16-6. At what amount should retained earnings be retroactively adjusted on January 1, 2021? So we got 2 years, 1990 and 2020, but we have to consider the adjusted amount on January 1, 2021. So we now create 3 columns. These are 2019, 2020, and the last column is for retained earnings. The first line, we have the 2019 inventory, which was understated. So 2019 inventory understated. The amount to be extended under the 2019 column, 200,000 add, and from the 2020 column deduct. Okay, now this is considered to be a reconciling treatment so that the error will be reconciled, no? The amount will be considered as reconciled after 2 years. So because in one column we add, another column we deduct. So repeat, the 2019 inventory understated, we add to the 2019 column and deduct from 2020. Next line, 2020 inventory overstated. Since it's a 2020 overstatement of inventory, so no effect on the 2019 column, but on the 2020. So on the 2020, since this is an overstatement, we have to deduct 300,000 from 2020. So deduct 300,000. And retained earnings will likewise be, we have to deduct 300,000. So repeat, 2020 inventory overstated, deduct 300,000 from the column 2020 and deduct from the column retained earnings. Next, 2019 depreciation understated. So 50,000 deduct from 2019 and deduct from retained earnings. Deduct from 2019 50,000 and deduct from retained earnings. Now that is in connection with the depreciations understatement. Take note that this is a non-counterbalancing error. Then for 2020, we have depreciation overstated. So we are going to add to the 2020 column and add to retained earnings. Okay, so the question now is asking for the retained earnings that should be given, adjusted on January 1, 2021. So now we refer to the retained earnings column, negative 300,000, negative 50,000, and positive 100,000. So the net decrease is 250,000. That's why we have letter B as in boy. Now that's for 16-16, P as in boy. Okay, we go to number 7. Okay, for 16-7, the question is, prior to any adjustments for these errors and ignoring income tax, what is the effect of the errors on retained earnings on January 1, 2021? So again, we create 3 columns, 2019, 2020, and retained earnings. So the first line, 2019 inventory understated. 2019 inventory understated. So under the 2019 column, we add 60,000. Under 2020, we deduct 60,000. So repeat, 2019 inventory understated. We add to 2019 column 60,000 and from 2020 column, we deduct 60,000. Next, 2020 inventory overstated. 2020 inventory overstated. So we have to deduct 75,000 from the 2020 column, deduct and deduct as well sa retained earnings, 75,000. So repeat, 2020 inventory overstated, deduct from the 2020 column, 75,000 and deduct from retained earnings, the amount of 75,000. So for the net correction, under the 2019 column, we have positive 60,000. Under the 2020 column, we have negative 135,000. And retained earnings column, we have 75,000. So what is the effect of the errors on retained earnings on January 1, 2021? The answer is C, 75,000 overstated. Next, 16-8 question. If none of the errors were detected or corrected, by what amount will 2020 net income be overstated or understated? So we now again create two columns, 2019 and 2020 for the second column. Then line 1, ending inventory. Ending inventory, and under ending inventory, we have 2019 in the amount of 150,000. Deduct from the 2019 column, we deduct 150,000. And 2020 column, we have to add. The question is, by what amount will 2020 net income be overstated or understated? So repeat, ending inventory 2019, deduct from the 2019 column and add to the 2020 column the amount of 150,000. And then for the year 2020, extend under the 2020 column, we add 200,000. We add, for the 2020 column, we add 200,000. Next, we go, but take note that your ending inventories, the 150,000 is overstated, whereas the 200,000 for 2020 was understated. Next, we go to rent expense. Rent expense in 2019 was understated. In 2020, it was overstated. So the treatments are rent expense for 2019, we deduct from the 2019 column, and the 2020, we add to the 2020 column. So the net amount, the question is, if none of the errors were detected or corrected, by what amount will 2020 net income be overstated or understated? So we just refer to the 2020 column, adding 150,000, 200,000, and 100,000, giving 450,000. That's our answer, and it's letter D as in dog. Next, number 9. Number 9 has 3 questions. Now you are given the following errors in the financial statements. The ending inventory for 2019 and 2020. For the ending inventory in year 1 is understated, in year 2 overstated, and the depreciation in year 1 understated. An insurance premium 150,000 was prepaid in 2019 to cover 2019, 20, and 21. The entire amount was charged to expense in 2019. In other words, the amount of 150,000 was debited to insurance expense in 2019. On December 31, 2020, fully depreciated machinery was sold for 250,000 cash, but the sale was not recorded. Take note that the machinery was fully depreciated. However, the selling price is still 250,000. However, this was not recorded. So you could have debited cash 250,000, debited accumulated depreciation, and credited cost of the machinery, which is just equal to the accumulated depreciation because it's already fully depreciated. So in other words, the amount of 250,000 as the cash received is considered to be an income. Now, there were no other errors during 2019 and 20, and no corrections have been made for any of these errors. What is the effect of the errors on 2019 net income, on 2020 net income, and on retained earnings on December 31, 2020? Okay, so we now have two columns. First column 2019, second column 2020. First line 2019 ending inventory, which was understated by 200,000. So we add to the 2019 column and deduct from 2020. So add 2019, deduct 2020. 2020 ending inventory, which was overstated in the amount of 300,000, deduct from the 2020 column. Remember, it was overstated. The 2019 depreciation was understated by 50,000. So we deduct from 2019 50,000. This error does not counterbalance. So we have only one column, 50,000. Deduct from 2019. Next, we have insurance premium, the amount of, the total amount of insurance premium paid was 150,000. That was paid in 2019. Then the company debited to insurance expense and credited to cash. However, because this is good for 3 years, at the end of 2019, you got 2 years prepaid, so meaning 100,000. And at the end of 2020, you still have 1 year prepaid. So you have these amounts of prepayments to be recognized. So that in your 2019 payment of insurance, when you charge everything to insurance expense, now in 2019, you have to add back 100,000. Why do we need to add back? Because in 2019, 150,000 was charged to expense, whereas the correct amount of expense is only 50,000. That's good for the year, and 100,000 is a prepayment. So we have to add 100,000. Why do we need to add? Because the amount of expense deducted was 150,000. The correct amount of expense is only 50,000. How about for the year 2020? Actually, the correct amount of expense in 2020 is still 50,000. So we have to deduct that because in 2020, no expense related to insurance was deducted because the amount of 150,000 applicable to 3 years was fully deducted in 2019. Next, we go to the machinery which was sold. Now we consider the cash received upon the sale of the fully depreciated machinery. The amount of cash received was a gain. So gain on the sale of machinery, 250,000. If we try to trace back the entry upon the sale, we debit to cash 250,000 and then debit accumulated depreciation, which is equal to the credit to the machinery account. And so we are going to credit gain on sale equal to the cash received. So we now have the gain equal to 50,000. Okay, questions? What's the effect of the errors on the 2019 net income? So the total in the 2019 column is 250,000. Add 200,000, add 100,000, and deduct 50,000. Under the 2020 column, what is the effect of the errors? We deducted 200,000 and 300,000 and 50,000. So that makes it 550,000. Okay, deducted. But we have the addition of 250,000. So, bali, ang 550, we deduct 250, the result is negative 300,000. So, what is the effect of the errors on the 2020 net income? Actually, there was an overstatement that we have to deduct back. How about the effect of the errors on retained earnings on December 31, 2020? As we move on to retained earnings, the column 2020, now we have the net income under 2019. As computed, it was understated. In the 2020, the net income was overstated. So we now have the amount of 250,000. And so from 300,000, we deduct negative 300,000 and positive 250,000. The difference now is the overstatement in retained earnings. So now 16-9, number 1 is A, number 2 B as in boy, and number 3 C. Next, 16-10. Ignoring income tax, what is the total effect of the errors on net income for 2019, for 2020, retained earnings on December 31, 2020, and working capital on December 31, 2020? You are now given the understatement and the overstatements for 2019 and 2020. When the company started its operations only on January 1, 2019, the financial statements contained the following errors. On December 31, 2020, fully depreciated machinery was sold for 110,000 cash, but the sale was not recorded until 2021. No corrections have been made for any of the errors. Ignoring income tax, what is the total effect of the errors on? Okay, 2019 net income, 2020 net income, retained earnings on December 31, 2020, and finally, working capital on the same date. Okay, we now create 3 columns. Column 1, 2019, column 2, 2020, and column 3, working capital, December 31, 2020. So 2019, 2020, and working capital on December 31, 2020. Okay, so what are now your items in the line? Okay, so we have now the line items. First, we have 2019 inventory understated. 2019 inventory understated. We add to 2019 column and deduct from 2020. Add to 2019 and deduct from 2020. Next, the 2020 inventory is overstated. 2020 inventory is here as stated, understated. So what happens? We are now going to deduct 150, and finally the effect of that on the working capital is also 150 deduct. So, bali ang aton nga 2020 inventory as stated is overstated. Over. Okay, I'll repeat. 2019 inventory is understated. So, add to 2019 column, deduct from 2020. So, okay na. Counterbalance. The 2020 inventory was overstated. So from the column 2020, we have to deduct 150,000. And on working capital, we have to deduct 150,000. Now again, we define working capital as the difference between your current assets and your current liabilities. So again, 2020 inventory, which was overstated, we deduct 150,000 from the column 2020 and deduct from the working capital column. Next, 2019 depreciation was understated. So we deduct 60,000 from the 2019 column. Since the error does not counterbalance, the effect is only for 1 year. So understated, meaning we have to deduct the understatement in your depreciation. For prepaid insurance, actually 100,000 for insurance expense overstated and 2020 understated. How about for prepaid insurance? Prepaid insurance 100,000 understated, 100,000 understated, and for 2020, we have to deduct. So repeat, prepaid insurance in 2019, we have to add. In 2019, we have to add 100,000. And in 2020, we have to deduct 100,000. And finally, the gain on the sale of the machinery, under the column 2020, we have to credit 110,000. So, in other words, the amount realized from the sale was totally considered as a gain because the machinery sold was fully depreciated. So the requirements are, number one, net income for 2019 is, so we add in 2019 column, 160,000 add, 100,000 add, so we now get 260,000 minus negative of 60,000. So the answer is letter B as in boy. B as in boy. Next column, 2019. 2019. Second requirement, net income for 2020. Net income for 2020, actually, we have the following amounts extended under the column 2020. Negative 160,000, negative 150,000, negative 100,000. So that makes it 410,000 negative and positive 110,000. So the net effect on net income for we have now 2020. The answer is 300,000 overstated. Then the last column will be the effects on working capital. The effects on working capital. Effect on working capital is the difference between 150,000 and 110,000. So 150 negative, 110 positive. We have now the net amount for 40,000. That's on working capital. How about number 3 requirements? How much will be your retained earnings on December 31, 2020? The effect on 2019 net income is 200,000, and the effect on 2020 net income is 300,000 negative. So the retained earnings December 31, 2020 is 100,000 overstated because of the previous computations. So finally, your retained earnings, which is overstated by 100,000, and the working capital is over by 40,000. So the answers are number 1, boy, number 2, A, number 3, A, and number 4, A. Okay, so we have now your answers to number 10. We go to number 11. The requirements are, what is the adjusted net income for 2020 and the adjusted balance of retained earnings on December 31, 2020. Again, we create 3 columns, 2018, 2019, and 2020. So here we have 3 years involved. So we create 3 columns, and the first line, unrecorded commission. Unrecorded commission for 2018, it's 220,000. So deduct from the 2018 column. Deduct from the 2018 column 220,000. And add to the 2019 column, we are adding the amount of 220,000. So deduct, add. Okay? 220,000. For that, we have to deduct from 2018, deduct 220,000, and from 2019, we are going to add 220,000. So deduct 220,000 from 2018 and add to 2019 column 220,000. And then for 2019, the unrecorded commission is 140,000. So we deduct it from the 2019 column and add to the 2020 column. So repeat, 2019 unrecorded commission to your 2019 column. We deduct 140,000 and add to the 2020 column. Next, we have now your ending inventory 2018, 19, and 20. The ending inventory were discovered for 2018 understated by 400,000. In 2019, overstated by 540,000, and by 2020, understated by 150,000. So in the 3 columns that we have created, the ending inventory for 2018, add 2018 column, add 400,000, deduct from the 2019 column 400,000. Now remember the 2018 and 19 and 20. 2018 is understated, 2019 overstated, and 2020 understated. So what will be the effects of this? You are now computing for the 2018 amounts of inventories and commissions. So ending inventory 2018, add to 2018 column, deduct from 2019 column. So add 2018, deduct 2019. For the 2019 ending inventory, we add, we deduct from the 2019 column, deduct 540,000 and add to the 2020 column, 540,000. Okay, 540,000. And the ending inventory on 2020, which was considered to be understated. So to the 2020 column, we are going to add 150,000. To the 2020 column, we add 150,000. So the net correction to income for 2018, the correction to income is 180,000. That is the difference between 220,000 negative and 400,000 positive. So correction under 2018 column is 180,000. Under the 2019 column, the corrections are at 220,000, we have to deduct 140,000, deduct 400,000, and deduct 540,000. So the total of our deductions is 1,080,000 and add 220,000. So the net deduction is 860,000 under the 2019 column. Net deduction, net decrease is 860,000. And under the 2020 column, we add 140,000, add 540,000, and add 150,000. So the total addition is 830,000. That's now for the year 2020. Okay, so the questions are, what is the adjusted net income for 2020? Our adjusted net income here is net income per book is 3 million. That's per book. And then we are going to add the net correction of 830,000. The adjusted net income is 3,830,000. That's letter A for number 1. For number 2, the question is, what is the adjusted balance of retained earnings on December 31, 2020? Okay, what's the adjusted balance of retained earnings on December 31, 2020? First, we have the net correction to income of 2018 is 180,000. That's add. Net correction to income of 2019, 860,000 deduct. So we have 180 add and 860 deduct. The net correction to income of prior years is 680,000. 680,000. And then we add retained earnings January 1, 2020. Given is the amount of 12,600,000. That is the unadjusted retained earnings in January 1, 2020. 12,600,000. Then we deduct the prior period errors of 680,000. Prior period errors, 680,000. The corrected beginning balance of your retained earnings is 11,920,000. The corrected beginning balance of retained earnings is 11,920,000. Then we add net income for 2020. The adjusted amount is 3,830,000. And finally deduct, we have dividends of 1,750,000, giving us the adjusted balance of retained earnings on December 31, 2020 in the amount of 14 million. So that is letter A. I'll repeat. Retained earnings, January 1, 2020, before correction, 12,600,000. Then the correction for prior periods errors, 680,000. Deduct. So the corrected balance of retained earnings beginning 7,920,000. We add net income for 2020, 3,830,000, and still we deduct dividends declared 1,750,000. The corrected balance of retained earnings on December 31, 2020 is 14 million. So that is letter A. Next, we go to 16-12. 16-12, as a result of the errors, what was the effect on net income for 2020? Here we have two columns again, 2019 and 2020. First line, 2019 ending inventory was understated. So under the 2019 column, we add 100,000. Under the 20 column, we deduct 100,000. So add, deduct. 2020 ending inventory was overstated. So under the 2020 column, we deduct 40,000. Depreciation understated for 2019, we deduct 40,000. For 2020, we have to deduct 60,000. Take note, depreciation is a non-counterbalancing error. Then accrued salaries unrecorded by 2019. From 2019 column, we deduct 80,000 and add to 2020 column 80,000. For the 2020, we add we deduct from the 2020 column, we deduct 120,000 for the unrecorded accrued salaries. So for the 2019 column, the net amounts are 100,000 positive, negative 40,000, negative 80,000. So the net result is 2019 column negative 20,000. In the 2020 column, it is negative 240,000, composed of negative 100,000, negative 40,000, negative 60,000, negative 120,000. So we have 320,000 negative and positive 80,000. The net result is 240,000. Again, it is negative for letter B as in boy. Number 13, the company reported the following errors. So we have now for the ending inventory and depreciation. None of the errors were detected or corrected, and no additional errors were made in 2021. What is the net effect of the errors on retained earnings on December 31, 2020? So we now begin with 2019 column and 2020. Ending inventory of 2019, we add to 2019, 50,000. Deduct from 2020, 50,000. So add, deduct. For 2020 ending inventory, we deduct from 2020, 100,000. Deduct. Depreciation of 2019, 150,000. Here, we have to add the amount of 150,000 because there was an overstatement. For 2020, again, there was an overstatement. So we still add. Now the 2019 column, the net effect is the net correction to net income 200,000. And to 2020, we have the net effect, net correction of 50,000. 50,000 is negative 50,000, negative 100,000, and positive 200,000. So the net effect is 50,000. Thus, it gives us the net effect of the errors on retained earnings on December 31, 2020 is 250,000 understated. Per corrections above, we have now the assigned. By what amount would current assets on December 31, 2021 be overstated or understated? So we have the net effect on retained earnings, 250,000. Okay. The current assets on December 31, 2021 are not affected because the overstatement of 2020's ending inventory would affect 2021 cost of goods sold. However, the depreciation error does not affect current assets. So number 2 requirement is 0. So the answer is D as in dog. We still have number 14. The question is, what is the effect of the errors on net income for 2019? So again, we create two columns, 2019 and 2020. December 31, 2019, inventory was understated. So add to 2019, deduct from 2020. Unrecorded purchase in 2019, deduct from 2019 column and add to 2020. Next, December 31, 2020, inventory is overstated. So we deduct from 2020, 800,000. Deduct. Okay, 2019 depreciation is over. This time we are going to add to 2019 column. Add depreciation does not counterbalance. Next is December 31, 2020, accrued rent income overstated. So under the 2020 column, we are going to deduct 300,000. December 31, 2020, accrued salaries understated. So under the column 2020, we deduct 150,000. And the unrecorded gain in 2020, we add to 2020 column the amount of 100,000. So in the 2019 column, the net amount is 250,000. That is taken by adding 500,000 minus 500,000 and 250,000. So the net effect is 250,000. And under the 2020 column, we have the following amounts: negative 500,000, positive 500,000, negative 800,000, negative 300,000, negative 150,000, and we have positive 100,000. So the net effect here is negative 1,150,000. The effect on 2019 net income here is understated by 250,000, and the effect on 2020 net income overstated, negative 1,150. So the net effect is 900,000. So 900,000 is the difference between 250,000 positive and 1,150,000 negative. The net effect is 900,000 overstated. Next, we go to problem 16-15. Question. What is the effect of the errors on net income for 2019? So we now have 3 columns, net income 2019 and 2020. By the way, 4 columns. Then second column, third retained earnings, December 31, 2020. In the last column, working capital on December 31, 2020. Again, the columns are net income. For net income, we have 2019 and 2020. Next, retained earnings, December 31, 2020. And last, working capital, December 31, 2020. In item number 1, actually there are 7 items. So we will just number them 1 to 7. Numbers 1 to 7. So for number 1, deduct from the 2019 net income, deduct 35,000. And 2020 net income at 35,000. So deduct from 2019, 35,000, add to 2020, 35,000. Then in number 2, we add 10,000 to 2020 and add 10,000 to retained earnings and add 10,000 to working capital. So what are now the columns affected? For number 2 item, net income 2020 at 10,000. Retained earnings at 10,000. Working capital at 10,000. Next, for number 3, in the amount of 25,000, depreciation for 2019 overstated. So we add to net income of 2019. So 2019 column, add 25,000 and retained earnings column, add 25,000. Then for number 4 is depreciation for 2020 understated. So the 2020 net income, we are going to deduct by 8,000 and retained earnings deduct 8,000. Next, number 5, December 31, 2019 prepaid insurance is understated. So to net income of 2019, we add 5,000 and 2020, we are going to deduct 5,000. So add deduct from 2019 and 2020. Then item number 6, December 31, unearned rent income overstated, 4,000. So 2020 net income, we add 4,000, retained earnings add 4,000, and working capital and add 4,000. So we add 4,000 and 4,000 and 4,000. Last, December 31, 2020, accrued salaries understated by 20,000. So the effects are net income 2020 deduct 20,000. Retained earnings deduct 20,000. And working capital deduct 20,000. Okay, so what are now the net corrections? For the net income 2019, the net correction is 5,000, being an overstatement. For the 2020 column of net income, we have now the correction of 16,000, understated. For the retained earnings, December 31, 2020, we have 11,000, again, understated. And the last, what is the effect of the errors on working capital on December 31, 2020? Now the following figures, a positive 10,000 and 4,000. Then we have negative 20,000. So the net effect of the errors is 6,000 overstated. So it's negative. Now we have problem number 15. Then problem number 16, the question is, what is the corrected income before tax for 2020? We begin from income per book of income per book 6,500,000 given. Then we have the unrecorded purchase. Unrecorded meaning it was not charged to purchases. So your cost of sales was understated. Net income was overstated. So we have to deduct 1 million. The understatement of our ending inventory again is 1.5 million. And unrecorded advertising income here, unrecorded advertising for 500,000 advertising was recorded when payment was made in January 2021. So in other words, at the end of 2020, this was considered as unrecorded and still unpaid. However, per books is still considered to be unrecorded. Then we have the unearned rent income equal to 300,000 for an equipment that is good for or applicable for 6 months was received on November 1. The entire amount was reported as income upon receipt. So upon receipt, the company debited cash and credited rent income when it should be recorded partly as earned income and partly as unearned. So the unearned rent income is that amount of 300,000 and pertaining now to 4 months. Only November and December portion are considered as earned, while the remaining 4 portion, 4 months, still unearned. So unearned rent income is 300,000 times 4 over 6. 300,000 times 4 over 6. So we now get 200,000. And the prepaid insurance is 200,000 times 6 over 12. So we now get the prepaid portion of 100,000. Okay, the question is, what is corrected income before tax? The answer is 6,400,000. I'll repeat the components. 6.5 million, deduct 1 million, add 1.5 million. So that gives us 7 million, deduct 500,000, and further deduct 200,000. But we add 100,000. So the net amount of income corrected is 6,400,000. So that's B as in boy. Boy. Next problem, number 17. Net income per book, 2 million. The overstatement to beginning inventory, 300,000 add. Understatement to ending inventory, 500,000 add. Remember, one is beginning, the other one is ending. Unrecorded insurance for 2020, deduct 50,000 and cash advance credited to sales is 100,000 deduct. So 2 million add 300,000 add 500,000 minus 50,000 and 100,000. So the difference now is 2,650,000. 2,650,000. And the last problem, what's the corrected net income for 2020? So again, we create two columns, 2019 and 2020. Net income per book, 2019 column, 4 million, 2020, 5 million. Overstatement of inventory, 2019, negative 50,000 and positive 50,000 for 2020. For the 2020 amount, we deduct it from the 2020 column, deduct 150,000. Revenue received in advance, 2019 deduct 250,000. And for 2020 add 200,000. Gain on sale of equipment, we add to the 2020 column, we add 400,000. So what are now the final amounts? Corrected net income, 3.7 million. But the question is asking for the 2020 net income correction. So we have now the amount of 5.5 million. 5.5 million. That's letter A. Okay, we go to number 19. Number 1, question, D as in dog. Number 2, C. Number 3, dog. Number 4, A. Number 5, C. 6, C. 7, boy. 8, A. 9, A. And 10, boy. Then 16-20, requirement na, number 1 question, 1 dog, 2 A, number 3 dog, 4 C, 5 C. Okay. So far we have covered the book from chapters 1 to 17. Statement of cash flow, which we have already finished. And now we will move to module number 12. Module number 12 includes several topics: book value per share, earnings per share, and your diluted earnings per share. Now, okay, before we start, let's now consider our book value per share. That's part of chapter 18. Okay? What are now included in your book value per share? And then we go to your earnings per share. Okay. What is book value per share? It's the amount that would be paid on each share, assuming the entity is liquidated. And the amount available to shareholders is exactly the amount reported as shareholders' equity. So the formula is book value per share is total shareholders' equity divided by the number of shares outstanding. The book value per preference share is preference shareholders' equity divided by the number of shares outstanding. And for the ordinary shares, ordinary shareholders' equity divided by shares outstanding. For purposes of apportionment between the preference and ordinary share, the following procedures should be observed. An amount equal to the par or stated value is allocated to the preference share and ordinary share. any balance of the shareholders' equity in excess of the par or stated value is then apportioned taking into account the liquidation value and the dividend rights of the preference shareholders. Liquidation value of preference share is the amount which the preference shareholders normally receive upon the liquidation of the corporation. The liquidation value may be more than the par. In the absence of a liquidation value, the preference shareholders shall receive an amount equal to the par or stated value. When preference share has preference as to dividends, the dividend right may be non-cumulative, cumulative, non-participating, and participating. Now, this is in connection with the types of preference shares. Okay, a non-cumulative preference share is one on which the right to receive dividends forfeited in any 1 year in which the dividends are not declared. Thus, the share is entitled only to the current year's dividends. So in other words, your dividends do not accumulate. Cumulative is one on which the undeclared dividends accumulate each year until paid. Thus, the cumulative preference share is entitled to all dividends in arrears. A non-participating preference share is one that is entitled to receive only the dividends equal to the fixed rate. And the participating preference share is one which is entitled to receive dividends in excess of the basic or fixed rate. Participating preference share may be fully participating with ordinary share on a pro rata basis or participating only to a certain amount of percentage. Now we go to basic earnings per share. That's already part of chapter 19. The earnings per share figure is the amount attributable to every ordinary share outstanding during the period. Ordinary share is as equity instrument that is subordinate to all other classes of equity instruments. Earnings per share information pertains only to ordinary shares, so not to preference shares. Okay, now have the basic earnings per share. The computation of the earnings per share is covered by PAS 33, requiring two presentations or earnings per share, namely basic and diluted, and the presentation of earnings per share is equal to entities whose ordinary shares are publicly traded and those that are in the process of issuing ordinary shares or potential ordinary shares in the public securities market. So we are now referring to the shares which are publicly traded and not part of a publicly held corporation. Now we have the uses of earnings per share. It's a determinant of the market price of ordinary share, thus indicating the attractiveness of the ordinary share as an investment. Measure performance management in conducting the operations and the basis of dividend policy of an entity. The basic earnings per share, net income divided by ordinary shares. So in other words, the basic EPS applies only to the ordinary shares. The fact that the preference shares have their own annual claims. So may carrying rate ang preference shares. And so only the ordinary shares are entitled to the basic EPS. Now, for diluted earnings per share, we have the multiple potential ordinary shares. In considering whether potential ordinary are diluted or anti-diluted, each issue or series of potential ordinary share shall be considered separately or individually rather than in the aggregate. So take note of this. Very important. In order to maximize the dilution of the basic earnings per share, each issue is considered in consequence from the most to the least diluted. The potential ordinary shares shall be ranked based on their contribution in terms of incremental EPS, and the one with the lowest incremental EPS is ranked first. Now we have the test for dilution for this case. Test for dilution. Options and warrants are dilutive if the option price or the exercise price is lower than the par, no? Lower than the par. The options and warrants are the most dilutive because options and warrants have no impact on net income. Net income. Thus, the options and warrants are ranked first in computing diluted earnings per share. Convertible preference share. The contribution of the preference share to net income is the amount of preference dividend that is avoided because of the conversion. The incremental EPS for convertible preference share is equal to the amount of annual preference dividend divided by the number of ordinary shares into which the preference share is convertible. If this incremental EPS is lower than the basic EPS, the convertible preference share is probably dilutive. If this incremental EPS is higher than the basic EPS, then it is anti-dilutive. For the convertible bonds payable, the contribution to net income is the amount of interest expense that is avoided because of the conversion. The incremental EPS for the convertible bonds payable is equal to the interest expense net of tax dividend divided net of tax divided by the number of ordinary shares into which the bonds payable is convertible. That's divided. If this incremental EPS is lower than the basic EPS, the convertible bonds payable is probably dilutive. If this incremental EPS is higher than the basic EPS, convertible bonds payable is anti-dilutive. So we have now the dilutive earnings per share, diluted and anti-dilution. Dilution arises when the inclusion of the potential ordinary shares decrease the basic earnings per share or increases the basic loss per share. In this case, the potential ordinary shares are dilutive securities. Anti-dilution arises when the inclusion of the potential ordinary shares increases basic earnings per share or decreases basic loss per share. In this case, the potential ordinary shares are anti-dilutive and ignored in computing diluted earnings per share. The computation of the diluted earnings per share is based on the as-if approach. The convertible bonds payable is converted into ordinary share, and the convertible preference share is converted into ordinary share, and the share options and warrants are exercised. Convertible bonds payable adjustments shall be made both to net income and to the number of ordinary shares outstanding. The net income is adjusted by adding back the interest expense on the bonds payable net of tax. the number of ordinary shares outstanding is increased by the number of ordinary shares that would have been issued upon conversion of the bonds payable. Convertible preference share, if there is one. The computation of diluted earnings per share assumes that the preference share is converted into ordinary shares. Net income is not reduced anymore by the amount of preference dividend. The number of ordinary shares outstanding is increased by the number of ordinary shares that would have been issued upon conversion of the preference share. Options and warrants. Share options are granted to employees, enabling them to acquire ordinary shares of the entity at a specified price during a definite period of time. Share warrants are granted to shareholders, enabling them to acquire ordinary shares of the entity at a specified price during a definite period of time. Options and warrants have no cash yield, but they derive their value from the right to obtain ordinary shares at a specified price that is usually lower than the prevailing market price. They are dilutive if the exercise price or option price is less than the average market price of the ordinary share. But for employee share options, the exercise price or option price shall include the fair value of any services to be supplied to the entity in the future under the option plan. By the way, your module number 12, the one I have just finished, the theory part, already includes several chapters, beginning from chapter 18. So 18, 19, 20, and 21. In other words, we are in module number 18. It's quite long, and we have to see to it that this will be considered as part of module number 12. 12 is quite long. Then after that, we have 13 and 14. Okay, so we now move on to the problems of chapter 14. The problems, I mean, of chapter 18 in 18-1. So we now go to 18-1 and here, 18-1. Okay, we have now 18-1. This is quite a long problem for our chapter 18. 18-1, the requirement is compute for the book value per share. Book value per share. Okay? Book value per share. Now, in book value per share in 18-1, we have book value per share is taken by dividing 8.8 million by 50,000. 8.8 million divided by 50,000. balik na screening has been stopped. Ano na? Ang balya okay? Hindi ko mag-okay. At depende lang na karon kay kundi code mo pa man nga iyalin mo sa gali tawid balang ko nga ina. By the way, since most of the problems in chapter 18 involve worksheet or columnar computations, it would be advisable to have these solutions actually printed and posted in the canvas instead of me dictating the solutions. So for the solutions to the problems in chapter 18, you can just refer to your canvas where we used to include our solutions before. Okay? So in other words, the solutions to problems in chapter 18, you can refer to the canvas. Siguro ang himuon mo,